Welcome to this explainer. Today, we're going to completely decode the massive 2026 resurgence of dividend ETFs, and more importantly, uncover the actual mechanics of building truly sustainable wealth. If you're serious about income investing this year, you've definitely seen some eye-popping numbers flashing across your screens. But as we're going to discover together, not everything is exactly as it appears. So here is our roadmap for the breakdown. We'll start with the 2026 dividend comeback, look into avoiding the yield trap, reveal the payout ratio secret, do a head-to-head with SCHD, VYM, and HDV, zoom out to the macro portfolio strategy, and finish up with building sustainable wealth. Let's get into it. Kicking things off with Section 1, the 2026 dividend comeback. For years, the market's obsession was literally all about growth, tech, AI, you name it. But the tide is turning. The search for stability and real cash flow is bringing dividends roaring back into focus. I want you to just imagine seeing a 20% return flashing on your brokerage app and asking yourself, is this too good to be true? Well, in the world of dividends, it usually is. But right now, in 2026, some of the most popular dividend funds are genuinely posting massive double-digit gains. Take a look at this incredible momentum. We're seeing funds like HDV and FDL just charging ahead, with year-to-date returns hovering right around that 19 to 20% mark. I mean, these are absolutely staggering numbers for funds that investors typically associate with boring, defensive income rather than aggressive, high-speed growth. Moving right along to Section 2, beware the yield trap. Now, it's incredibly easy to look at those massive returns and draw completely the wrong conclusion about how much cash is actually landing in your pocket. Check out this number, 23.76%. That was the reported year-to-date total return of the super popular ETF SCHD through late July of 2026. Seeing this, you might immediately think, wow, no way, I'm earning nearly 24% in income. But, because here is the reality check. This much smaller number, about 3.3%, is SCHD's actual distribution yield. This proves a vital, unbreakable rule of investing. A massive return absolutely does not equal a massive dividend payment. Remember, total return includes both the share price appreciation and the dividends. Most of that 23% gain, it just came from the underlying stocks going up in value, not from cash being directly handed to you. So, the crucial point here is understanding what we call the yield trap. This is where a crashing stock price mathematically inflates the yield, masking a deteriorating business. Think about it. Yield is simply the annual dividend divided by the stock price. So if company A's stock price falls off a cliff, its yield skyrockets. That 7% isn't a gift. Actually, scratch that. It's more like a blaring warning siren from the market that a dividend cut is coming. We always want to be company B, consistent, growing, and healthy. Which brings us perfectly to Section 3. The payout ratio secret. So, if we've established that chasing headline yield is a massive trap, what should we be looking at instead? Well, we need to dig a little deeper and look at the payout ratio. This metric is basically your best friend when trying to figure out if a company is stretched way too thin. It tells us exactly how much of a company's profit is being paid out to you and how much is being kept to actually run and grow the business. Frankly, it's the ultimate margin of safety for any income investor. It's kind of like a giant game of Jenga. Take General Electric's historical downfall, for example. If a company ignores its free cash flow and pushes its payout ratio over 100%, the entire structure eventually collapses into a forced dividend cut. GE looked like it had this incredibly safe dividend on paper, but behind the scenes, its free cash flow payout ratio exploded past 100%. They were literally cannibalizing their own structure just to maintain an illusion. To put that into perspective, look at this breakdown. The 35% to 60% range, that is often the absolute sweet spot for sustainable income. In that specific range, companies are perfectly balancing shareholder rewards with reinvesting in their own business. On the flip side, anything over 80% puts you in the danger zone and requires extreme caution, unless we're talking about specialized sectors like REITs or utilities. I mean, if a standard corporate business is paying out 90% of its earnings, one single bad quarter means that dividend is getting slashed, for sure. Okay, let's get into the heavyweight showdown in Section 4, SCHD versus VYM versus HDV. So instead of trying to pick individual stocks and constantly sweating over their payout ratios, a lot of savvy investors just use ETFs. Here is how the big three stack up right now in 2026. SCHD leans heavily into quality and dividend growth with an incredibly low 0.06% expense ratio. VYM, It offers super broad, diversified exposure for a mere 0.04% in fees. And then there's HDV, which aggressively filters for sustainable cash flows and healthy balance sheets, serving as this really stable income shelf. Now, seeing those numbers begs a really important question about investor priorities. Why wouldn't everyone just pick the higher yield? Well, because choosing the right fund depends entirely on whether you need maximum current income today or long-term dividend growth for the future. A 25-year-old might absolutely favor the growth and quality screens of SCHD to compound their wealth over decades. But a retiree? They might lean toward VYM's broad diversification and different cyclical tilts to stabilize the portfolio they're living on right now. The best ETF is simply the one that matches your exact objective. Let's zoom out of it for Section 5, the macro portfolio strategy. Because no ETF exists in a vacuum. They are all totally at the mercy of the shifting tides of the global economy. With interest rates expected to drop, the relative attractiveness of dividend strategies and income-producing assets is shifting in a big way. Global investment research is pointing to a defining year for equities, with policy rates easing by at least 200 basis points. As bond yields drop, the stable, reliable cash flow of dividend stocks suddenly becomes significantly more valuable to major financial institutions. And global investment firms are strategically adapting to this. They're utilizing asset allocations that look a lot like this: a 50% core in equity funds for growth, a dedicated 20% carve-out for high-dividend yield stocks and REITs just to capture that stable income, another 20% in income funds, and a 10% money market buffer for liquidity. This right here is exactly how you build a portfolio designed to weather any economic climate without betting the whole farm on a single asset class. Which brings us to our final part, Section 6, Building Sustainable Wealth. At the end of the day, knowledge is only power if you actually apply it systematically. If you're out there comparing dividend ETFs, stop chasing a single flashy headline number. You should always calculate the total cost of ownership using these 4 absolutely critical metrics: the current yield for your cash flow, the total return to ensure the underlying assets are actually making you money, the expense ratio to prevent fee drag from eating your returns over decades, and dividend growth to make sure your income is actually outpacing inflation. And to really build a predictable income sleeve, you should follow these exact 3 steps to guarantee automated compounding and disciplined capital stewardship without ever trying to time the market. By dollar cost averaging, you smooth out all that crazy market volatility. By turning on DRIP, you allow your dividends to just automatically buy more shares, creating this massive snowball effect. And by rebalancing, say quarterly, you maintain your intended risk profile over the long haul. This quote really hits the nail on the head. The shift in the 2026 market is super clear. Serious investors are no longer just looking for quick cash flow. They want cash flow combined with growth and quality. We've got to move past the alert of double-digit yields that are actually just mathematical illusions caused by crashing stock prices. We really have to look at the health of the underlying machine. So as we wrap up this explainer, I really want you to take a close look at your own investments and ask yourself, are you just chasing a short-term illusion, or are you actively building a machine that prints reliable cash for your future? The data, the payout ratios, and the macro environment are all giving us the clues we need right now. It's up to you to put them all together. See you next time.